Good evening, everybody. It's great to be back here again. And an interesting year we have to talk about. Obviously, we've moved this meeting from Wednesday night to Thursday night, which enabled you, unfortunately, to watch a hockey game last night. Tonight we're up against the NFL draft. I'm not too worried about that because my Super Bowl champion Philadelphia Eagles picked last. So. Thought I might pick full flat, so go with Winnipeg. Let's just want to first summarize our investment strategy and approach. And we are, as the one manager said as well, we're also value managers. We look for investment bargains, and we invest similarly to the way we go around when I go grocery shopping. I'm looking for what's on sale, what's a great deal, and trying to look for those types of investment. We invest via closed-end funds, which are investment pools that invest in various different strategies and give various different types of investment exposure. And those are listed on stock exchanges, and they trade at discounts and sometimes premium to their underlying net worth. And what we try to do is buy those funds that are trading at their widest level of discounts relative to that individual fund's range. So in constructing a portfolio, we create a diversified global exposure to the corporate sector worldwide. An important part of this strategy is reversion to the mean. What that means is that in terms of the discounts that we invest in, we see that they are mean reverting. So when they are wide, they tend to narrow back to their average levels. We also believe in mean reversion in terms of markets, in that we believe there's business cycles and cycles in markets, and not everything stays in favor all the time, and what's flavor of the month one year can be the worst thing you can invest in the next year. So we lean against whatever is popular in the markets at a time. And our team, we focus, our company focuses solely on closed-end funds. And so, we've been doing this for a while, so you're accessing an experienced investment team investing in this mandate. So the investment process, we have a dedicated couple of macro economists who provide us some guidance on markets and where they think the world economy is going, which markets offer the best valuations. And then what we do is we take that kind of where they think are the best opportunities and overlay that with the value that we see available within our closed-end fund universe. So we do a lot of bottom-up work, meeting with closed-end fund managers, understanding their investment processes, and also the structure of the closed-end funds and what may be a catalyst for a discount narrowing. So I want to give an example of, and there's a lot of data on this slide, but it's a good example of how this process works in action. So this is, on this slide, is an example of a trade, two trades that we've actually done. One's a buy, one's a sell. And it's in JP Morgan Japanese Investment Trust. And this is it's managed by JP Morgan. They invest in a portfolio of large cap Japanese companies. And it's got a history of long-term outperformance of the underlying Japanese benchmark. So we purchased this trade in April 2016. At that point, its net asset value was 337p. That's the underlying worth of the portfolio per share. The share price at that time was 285p. So that's a 15.4% discount to the underlying net worth. So effectively, you're paying 84.6 pence for every 100 pence of assets. We held that security and then initiated a sale earlier this year in April 2018. At that point, the NAV was 476p, so the value of the investment portfolio had risen there, and the share price had risen to 448p. And within that period, we'd also got dividends of 8.65p. So, and during that time, the discount had narrowed to 5.7%. So effectively, that's nearly 1,000 basis points of discount narrowing over that time. So then at the bottom, we have the holding period returns. The NAV return, which is the return of the investment portfolio itself, what the stocks that the manager invested in, returned 43.8%. The benchmark return of that portfolio, which was the MSCI Japan index, returned 37.5%. So over that period, the manager had outperformed his benchmark. And that's the NAV component. When we look at the attribution, that's the NAV component of our returns. If you look at MSCI Japan versus MSCI World, that's MSCI World is the benchmark of the Tradex Global Equity Fund. And so over this period, MSCI Japan outperformed the MSCI World. And in our attribution, that's the combination of the country and currency portions. And then the share price return was 60.2%, which outperformed the NAV return. And that represents the discount narrowing, and that's the discount component of our attribution. So we look for these types of opportunities. They don't always go as well as this one, but and we try to repeat that over and over with different closed-end funds. And if you repeat that and you're successful more often than not, then you generate good performance. So in terms of the last year, as has been mentioned, equity markets did pretty well. These are gross indices performance. They don't take account of taxes. And overall, the MSCI World over the last year returned 10.7%. US was basically in line with that. Europe large cap was one of the outperformers. That returned around 12%. And Canada, Australia, UK, weaker than the benchmark. Other areas that were positive was Japan, and also emerging markets did pretty well last year as well. So investing ex-US was really the place to be last year. And then I've included a couple of areas on here. Small cap performance was particularly strong last year, and that resulted in excess returns. The other key here is that currencies generally were stronger against the Canadian dollar, and so that helped returns last year as well. So in terms of our performance of the portfolio, it's highlighted in yellow. The portfolio returned 15.3% last year versus 10% for the benchmark. And then, as I was mentioning, those components of attribution, country and currency, which we kind of combined were positive. That was largely, we were underweight to the US dollar, and that weakened versus many other currencies. The NAV component was slightly positive. That's a little bit reduced because fees and expenses come out of that component. And then the discount area was very strong last year, and was the main catalyst for the outperformance of the benchmark. As we look at that, this is the size-weighted average discount. And as you can see, it shows a narrowing trend over the year. What first quarter 2018 shows a little bit is just us cycling out of funds that have done well, which have narrowed the discount, and then reinvesting your capital in funds which have wider discounts. This doesn't completely reflect how much value is in the portfolio, because with closed-end funds, it's all about the discount trading range as opposed to the absolute level of discount. So something on a 5% discount can represent a better opportunity if that's at the wide end of its discount trading range than something that's say at a 10 or 15% discount if that's at the narrow end of that fund's discount trading range. In terms of our performance drivers last year, going a little bit more into depth on there, we did invest in a number of funds which offer small cap exposure, and partly that was a result of the Brexit vote in the UK. That resulted in a lot of value both in closed-end funds and also the underlying. So after the Brexit vote, we had UK small caps which had become underperformed the market as a whole. The currency was weak, and also the discounts on those closed-end funds were also a lot wider. So this was part of that mean reversion trend where things had, the pendulum had swung too far in one direction, and this was outperformance coming back through discounts and NAV performances. Japan was also a strong area, particularly in terms of NAV performance from the funds that we invest in. Being underweight US also helped performance because US didn't do as well as some other markets. We also participated in a rights offering, which is particular to closed-end funds, but often allows a discounted entry point, and that was something we were fairly aggressive in, and resulted in significant outperformance from participating in that. Being underweight Canada or Australia, which were two markets which underperformed, also helped, as well as our investments in the financials and tech sectors, which did well last year. Detracting performance, MLPs, energy infrastructure funds, did not do well last year. We think it's a very attractive area, but they did not come through last year. UK large cap as well did not do well, and healthcare and biotech funds also didn't do well. And then finally, Pershing Square was a fairly high-profile investment that did not do well with its underlying NAV. In terms of the global environment, obviously one of the major factors this year has been the US presidency, and obviously there's a lot of volatility around that. A lot is said, we have tweets every day, and it creates a lot of noise, a lot of distraction in the market, because one day you'll hear it's very aggressive one way, we're going to impose lots of tariffs on China, and then it's not so much. So that is very distraction. I think what it means is there is going to be more volatility in the market because markets react to these events, albeit not over elongated periods so far. The trade wars situation is obviously a watch this space. We'd expect that to continue, partly because the base of Trump's support is really, really wants that. So talking a good game gets points with that group. In terms of the last 12 months, obviously economic growth has been very strong worldwide, and that's been pretty supportive for the equity markets. And whereas it's been reasonably strong in the US for a time, we've seen Europe, Japan, emerging markets also have strong growth as well. So we do see now, obviously in the US, having some interest rate rises and that kind of unwinding of this quantitative easing. What we haven't really seen much so far, which is somewhat surprising, is an uptick in inflation. You know, US is effectively at full employment. You would expect that kind of wage growth to start coming through. And that may well be the case. Obviously, we've just seen the 10-year Treasury in the US going through 3%, and you know that could rise further. The tax reform or tax cuts, whichever you want to call it, quite surprising in terms of the timing. You normally have fiscal stimulus when the economy is not doing so well. We're having it when the economy is firing on all cylinders, and you know, as has been mentioned, you know, it's unfunded, and so that creates a liability further down in time. So, but what that tax reform did, and was undoubtedly the case, is that it's very good for US corporates. So therefore, it's very good for equities in general. It is effectively a corporate giveaway. So whereas the markets in the first quarter haven't really done very much, actually valuations have become more reasonable because what we've seen is very strong earnings growth from US companies. And that should provide some underpinning to the equity markets. Obviously, there are potential offsetting effects if we start seeing inflation come through and interest rate rises, but earnings growth is what you invest in for companies, and we are seeing strong earnings growth, so that should be a support of the markets. I mentioned one of the areas that we're particularly interested in is the US energy infrastructure sector. That's pipelines. We've had a lot of growth in US oil production, US natural gas production, US exports of liquefied natural gas. We're beginning to ramp that up. I think it's a very attractive area. It's been it's sold off quite heavily, so it's an area that we're looking at. We think it's quite useful, and we think it's also a strong help for the US economy going forward. You know, earnings growth has also been good in outside of the US, and valuations still favour ex-US, Europe, Japan, and so that we find those areas quite interesting as well. The UK continues to labour under the Brexit negotiations. They're in a very weak position, I think, in terms of negotiations, and so it's hard to know exactly how it's going to play out, but it's the uncertainty that it's generating has weighed on UK equity prices, and that does seem to be one of the cheaper markets. And if we get the market is pricing in effectively a hard Brexit outcome, and if we get something other than that, that could help the UK market as well. You know, what does this all mean? Well, I mean, it's going to continue to be volatile markets, but we do think that earnings growth will help underpin the markets. We think we continue, and we would say this, but focus on where the value is, try to buy cheap assets, try to buy things which are out of favour. And I think one of the things also you have to think about is that, yes, we're getting good returns now, but the piper eventually will have to be paid. You cannot keep on running up debt and expect there to be no effect. The widening fiscal deficit that the US has means more treasury issuance. That probably means higher treasury yields. That probably slows or provides restrictions on the economy going down. So we're effectively borrowing returns from the future. So We may continue to have another good year, but at some point this is going to have to be addressed. And right now we have the baby boomer generation, which have got great benefits, but eventually they're going to start becoming not the major voting bloc. And the millennials, who are going to be footing the bill for all of the debt, there could be repercussions there, particularly in terms of the healthcare and retirement benefits in the US. So it's an interesting situation. Next slide just shows portfolio characteristics. We are still underweight the US. We have reduced that from where we were before. And that's partly because we do see better valuations, and also because areas where the portfolio's done very well, Eurozone, particularly Eurozone discounts, we've reduced that Eurozone overweight and much more of a neutral position now. We think UK offers some value, and we could increase that weighting. We are overweight to Japan. We think Japan still offers good values at the corporate level. There are some political clouds on the horizon with Abe having some scandals that he's having to deal with. But we think the value is there in terms of the corporate sector. And we also have some small overweight positions in Asia Pacific and emerging markets. From a sector point of view, the major area where we have an overweight is in energy. Energy's been an underperformer for some time. This is partly energy companies, exploration and production, but also that energy infrastructure, the pipeline investments that's pushing that energy weight up. So just to summarize, very much value approach, use closed-end funds, and in terms of positioning, overweights Japan, Asia Pacific, emerging markets, underweights continue US, Canada, and Australia.